All right, well, good morning, everybody. My name is Mark Robertson. I'm joined here by Ken Kavula and a few members of our Chicago long-term investing community. And basically, what we'd like to spend a few hours going over a few things. I'm just sitting here, I'm reminded of a time several years ago when we had a president's forum, the Chicago chapter here put on, and the investment club presidents were all invited out. We had like 40 people registered to come, and an ice storm hit that night. And we don't have an ice storm out there today, but you know what I'm telling you here. We ended up with like 6 people in the room, and what the president at that time, Quentin Sampson, had everybody do was pull chairs just into a circle and just gather up. Probably one of the best meetings I've ever attended. So I think that's what we're in for here today. We're going to basically have the opportunity to go over a number of things. For those of you joining us across the country, we have a number of online attendees. You probably are sitting there in your pajamas sipping coffee. That's fine. That's good too. But please feel free to chime in and enter the conversation. I mean, this is intended to reach out to a spectrum of investors, but we have a fairly high level of experience here. John, how long have you been investing?
15 years.
About 15. You guys are over 20. So a fairly high experience level in the room. I don't know what the case is. If you're a relatively new investor in the online audience, would you drop us a note? Which tab do they have to hit, Ken?
Questions.
The questions. Actually,
Yeah.
just drop us a note if you're less than 2 years as an investor, and that might allow us to tailor some of the conversation to you. But the message is the same, regardless of experience level. One of my favorite things to point out is one of my friends from North Carolina, very respected in the NAIC community. His name is Dan Hess. And Dan is probably into his 70s now. He considers himself a beginning investor, even though he has literally been doing it for over 50 years. He thinks he learns something new all the time. We're always learning from each other. So in that respect, I still consider myself a beginning investor. For example, just 5 minutes ago, Ken showed me something I didn't know about my own website and what it did with the stored eagles. So it's a nonstop process. In that spirit, please don't be afraid to ask questions and ask us to expound on something or drill in a little bit deeper. Our emails are there. Again, the one common theme, I think, depending on where you are in your life experience, we really do regard investing as a journey. And I really believe that it's no more complicated than having enough gas in your tank, enough air in your tires, enough oil on the dipstick, and there are basically corollaries all throughout investing, and we're going to talk about some of that today. Just making sure everything is set up to go on this journey in the right direction. In that respect of an investor, and then we'll have Ken comment on this. Again, if you're relatively new to this, one of the things we recommend is just be a sponge, S-P-O-N-G-E. Be a sponge. If you hear things that you've not heard before or are mysterious or you're curious about, write them down and go exploring. You know, attend a local chapter function for better investing. Attend some of our meetings like this. Take the mystery out of it. That's what we're here for. Ken, as a member of 19 investment clubs, is an expert on dealing with the mysteries of investing. What's your advice for this situation?
I don't do this very often, but with the size audience we have, I'm shouting out to Irina in Washington. Irina, you're registered twice on the webinar, and we find that sometimes causes significant technical issues. So if you're having technical issues, you want to take, and if you possibly can, take yourself out of one of the registrations or just completely go out of the program and come back into it again if you're having problems. If you're not having problems, then the double registration won't hurt you at all. Now, Mark, I forgot the question.
She just wants a double helping.
She wants a double helping.
I'm just saying any global advice for investors, depending on where they're at in their spectrum of experience.
Well, you know, I hate doing all this stuff by myself, so my advice always is at least find a partner. My wife is a true partner when it comes to our investing and everything that we do with our saved cash. But the clubs themselves are great areas of support. We've spent the last 2 club meetings at the last 2 model clubs that I've been to. One is a large club of 25, one is a medium-sized club of about 15 people. And we've spent those meetings just basically hand-holding, just supporting each other and encouraging us to follow the basic tenets, which are to stay invested and to invest regularly. You know, you always have new investors in these clubs, or even yourself, there were times in the last 4 weeks when I've had a kind of a queasy stomach as to where we're going to go next.
Don't talk about queasy stomachs.
But you still have to follow the course, stay the course, and I've been through 4 or 5 of these downturns in my investing history, and my goodness, you always come out of them stronger than you went into them. So I'm confident that we'll come out of this one as well stronger. And I never like to finish that thought, but in order to finish it for this audience, and if we don't come out of it, there's not a whole lot you're going to do with the cash you lost anyway if we don't come out of it. So I don't know, maybe that's fatalistic, but I have confidence that we're strong enough to weather whatever the problem might be. We're getting some questions right now. Irina is saying she was on 2 different devices.
Oh, okay? You techies out in D.C.
She's also letting us know that if we want to take a look at the Northern Virginia Model Club dashboard, she's willing to put that up and
maybe we'll do that later.
Give us a show of that dashboard, okay? So let's move on with our legal stuff.
All right, we got to take care of the legal paperwork here for a minute. We're obviously going to be talking about real companies and analysis here today, so we want to make it clear no investment recommendation is intended. This really is about demonstrating the principles and philosophies of the modern investment club movement, and we think the best way to do that is to bite into companies that we are following and studying as a group and basically learn from each other. So that's why we do what we do. And I went through the classes 20 years ago when you studied company A and everything was obscured and all that. That just didn't do as much for me as the stuff that we'll actually go into today. So please do your own homework and keep in mind that this is for illustrative purposes only. This is what we have in mind for the next couple of hours. We do want to visit the type of things that we know have been successful. We want to demonstrate some of that, talk about the long-term story. We probably won't spend a whole lot of time with that because we don't have too many people that aren't familiar with the story of the modern investment club movement, but we'll do some reminding as to why things that are out there are so important. Spend some time just digging into the nuts and bolts, but pretty much going where you want to go. One of the things that we talked about doing here a little bit differently, a lot of times we do programs like this, and we get to that last hour or so, and then we'll put on a session, either a Let's Talk Stock panel or a Two Guys Talk Stocks. We thought, why don't we just change it up a little bit? Everybody that's here today has a little bit of experience, at least as an investor. Everybody wants to discover and share ideas, so we thought we might kick off the program and just spend whatever time makes sense with doing that. Are you up for that, Ken?
I'm up for that, Mark.
Okay. And there's our reminder at the bottom. If there's something that you want us to dig into a little bit deeper, or there is no such thing as a stupid question. Bring them out and we'll take care of them. If it is something we have to address in a different venue, we'll certainly take care of that. So let's go ahead and get underway with our Two Guys Talk Stock session. We'll give you a little bit of history here. That's actually a cover story slide from a fairly recent article. It's one of my favorite pictures of all time. It was snapped by the photographer of the St. Louis Post-Dispatch. And the caption under the article read something about Two Guys Talk Stocks, and then in parentheses it said, Mark Robertson, not pictured. So, I have Two Guys Talk Stock, Mark not pictured. So I have a bone to pick with that photographer, but he was really a fascinating guy. He was basically sent to take pictures for the local newspaper. He ended up hanging out and lingering in our session. And Ken spent the most amount of time with him. Go ahead and give him some idea of what he was curious about, Ken.
Well, he interviewed us at the very end of the session. This was a well-attended session, maybe over 100 folks in the room, and a very engaged audience. And we were able, during our Two Guys session, to bring the audience, to bring them up with oohs and ahs, and then to get them laughing at something and to get them booing at various things. And we were able to do it by just putting graphs like this one on the board. And you folks that are in Better Investing, that have been in BI for a long time, know that when the lines are up and when they're straight, when they're parallel, that's the kind of stock we really kind of drool over. It's a good, consistent grower. It's the kind of stock we like to investigate for further investment. So when those went onto the board, the audience would go, ooh, and when you'd put on a roller coaster, kind of the stocks that Hugh McManus likes to invest in, sometimes we'd get them booing it or we get them laughing at it, especially when we put up stocks without a blue line, without any earnings. We'd get hysterical laughter about why we're even considering that. And the guy at the end came up to me and he goes, "Are you guys running a cult?" He wants to know. He says, "What are you doing to get this kind of reaction from an audience?"
He actually said, "Who are you people?" I remember that.
He said that you're keeping this this audience engaged for over an hour, and that's a long time to keep a group that size engaged. And so we admitted it was nothing more than applying a very simple investment philosophy, and he was fascinated. And like I said, like Mark said, he stuck around the whole session. He went to a couple of other sessions where he took pictures and then stuck around as well. So I don't know, maybe we converted another person to the philosophy and turned somebody into an investor.
I certainly hope so. It reminded me of a time several years ago in Atlanta where I was giving a presentation, and literally the president of the chapter came up when I was done with one at 1 o'clock, and he comes up and whispers in my ear, "Oh, you got the next hour too." And I broke into a cold sweat or whatever. And then what I did, just on a whim, is I got out a bunch of these visual analysis and what we now know as chronicles, and we had trouble getting out of the room in an hour because we just put company after company up there, and that's kind of where this whole notion, kind of came from. That's what everybody's here for. You really do remove a lot of the mystery of investing when you start looking at those type of images and pictures and responding to what's important. And that's some of what we'll cover here today.
When the two guys first took the stage about 7 or 8 years ago, this was a controversial, revolutionary concept as far as better investing was concerned. All of the wiser hats in the room were suggesting that Mark and I were going to fall flat in our face, and furthermore, we don't talk about particular stocks with better investing. And the counter argument was, why not? And nobody could ever tell us why not. So we said, well, then let's do it.
The last time I checked it, there's a room full of adults. So
yeah, and it became one of the most popular features at convention, and still draws a huge audience whenever we do the program. So we're happy to do it. We're glad people enjoy it, and let's look at some of our tools to identify stocks that we like to talk about.
All right.
Mark's on the Manifest website, his favorite website, and he's going to Stock Search.
Okay. And I think, Ken, why don't you go ahead and kick us off with a demonstration of the ivory silk screen. That's the next slide in their handouts.
Okay. Well, there's a number. It's a relatively easy Stock Search screen. You can eliminate certain sectors or focus on certain sectors. You can eliminate or focus on certain industries, but there's not too many fields to actually fill numbers in. One of my favorite screening things, however, is to just use a single number, and that's way down at the Manifest rank. Mark puts together a number that's proprietary. That means that he's not going to tell you how he does it, okay?
I might tell you.
But he puts together a number basically that's a combination of PAR, that's the potential annualized return, and quality. So the stocks that make the top of this screen are very, very high quality stocks with PAR that's 5 points or more above the market average. We refer to the market average as MyPAR, Manifest Investing Potential Annualized Return. And so we're looking to follow George Nicholson, who always told us you can beat the market by 5 points without going into this side trip. That's where the 15% that you hear all the time in Better Investing really came from. It was just Mr. Nicholson saying you can beat the market by 5 points. So this Manifest rank, I'm going to look for the top 0.5%. And the number to remember is, this is a really old reference, but Mark uses it all the time. The old commercial for Ivory soap.
There's enough experience.
That was 99 and 44 100% pure. So 99.44 is the number he puts in there. He calls it an Ivory soap screen. and we end up with 15 or so stocks that are in a really good position for you to study, for you to take a look at. In a typical better investing portfolio, are you taping us or picturing us right now? Videoing.
Videoing. 45 seconds.
That I want to let folks know that we have 20, 22 or 23 people online, so this is not our entire audience.
Okay.
It's 30 people
That's
here.
fine.
Okay.
I just need you two because I've done at least
All right, and we're talking about stocks that might be interesting for investment purposes right now. And in a typical better investing portfolio, I would suggest that most of you hold 3 or 4 or 5 or more of these stocks in your portfolio right now. If most of the names aren't familiar to you, then that gives you a good jumping off point.
Yeah.
Look at stocks that you're not familiar with. That's a great jumping off place.
In the green room session, John asked the question about, how much time should you spend? What type of things should you be doing? As an investor, one of the things that I will do, like on a Saturday morning, like right now, is sit down and run the screen. And I'll actually break the veil of silence or the veil of the cloaking device. The manifest rank that Ken's referring to, there's nothing mysterious about it. The math's a little bit tangled, but all it is recognizing what Nicholson, as Ken was saying, what Mr. Nicholson taught us is the most important things. Figure out the return forecast, build expectations for your company, and follow that up with stick to the higher quality companies, stick to the industry leaders. All the manifest rank does is takes those two things and weights them fairly equally. So you're basically looking at a list of companies that have decent return forecasts and high quality, versus their competition or peers. So again, in John's case, if I'm looking for a company to add to a portfolio to deploy cash on a Saturday morning, this is one of the first places I'm going to start, John. Is is there anything on there that really grabs my attention? Notice Biogen, which by the way, on Tuesday morning was at the top of this list, is now moved down because that was featured last Monday night, and apparently everybody ran out and bought it. That was a facetious comment.
That was Cy and I. We did it. So you'll notice in the upper right-hand corner, there's that MyPar number I was talking about. The historical average growth number for a stock over the last 100 plus years has been around 10%. So with the average for this database at around 9%, we're approaching just average returns as they've been historically for quite a while. Now, in recent history, say the last 15, 18 years, the average for the market probably has been a little bit lower, maybe around 8%. So we're actually a little bit above the most recent history, but we're down based on long-term history. Mr. Nicholson's advice, beat the market by 5 points, and Mark says, let's not be greedy. When it gets to be more than 10 points above the market average, you might have a little froth that's entering into the analysis. So those with the yellow background right there, those are kind of frothy. We'll look at them, however, because of their extremely high quality numbers. If these were yellow background stocks with quality numbers of 30 or 40 or 50, we probably would exclude them from consideration almost immediately. But because these have really high quality numbers, and because we're not that far off the top of the 10-point region, 19 to the 21.8 isn't that far away, we'll take a look at these. Is there a company, we have our 3-person home audience here, is there a company that doesn't sound familiar to you on that list that you can see?
Or anyone that you're more interested in?
Or would you like us to pick one that's a favorite of ours right now?
We've actually looked at a number of those in the roundtable. What do you guys think? Anyone there grab your attention?
What about that LXFT?
Well, that's Luxoft. Yeah, that's an ADR. It's a fairly new company, 3 or 4 years old. It's a Swiss company, and fairly interesting to take a look at. I did a little bit of research. Notice that it's not a standard value line sheet. It's an extended value line sheet, so no analyst opinions, no analysis as far as the paragraph's concerned. But if you scroll down a little bit, Mark will show you that there is an analysis, not an analysis, but a description of what the company does. And you can read that as well as I can read it, I think, on your screens there.
And it's probably worth noting that, we have had a success, many of the people in the audience have had success with companies like Cognizant, Infosys, Accenture. Without reading it too closely, these guys are in that business. So they're in the business of providing, consulting type. Obviously, they make some software too.
Yeah.
It looks like they predominantly make software. So they may actually have some of those companies as customers too.
Yeah, let me lay out what I did for research for this company, because it did come up on the screen. It was unfamiliar to me as well, and so I did take a look at it. The first thing I did was read what we just showed you right on the value line sheet, and frankly, I thought there was a little bit of double talk in that description. There was a lot of words, but it wasn't telling me a whole lot about the company. I did discover that it was an ADR, that means an American Depository Receipt. I did discover by going to my data source that it has a fairly short history of being publicly traded.
It's certainly shown on the screen.
Yeah. And so the next place I went was to their website. Frankly, I was disappointed. A lot of small company websites are great. They're full of a lot of explanatory material. They give strategies for growth. They talk about a lot of things about the company. This website was pretty sparse. And at that point, because I couldn't find a whole lot of information, and because it had so little financial history, I excluded it. I just stopped my study at that point. If you're still interested, of course, you're going to have to dig a little bit deeper, because there are no real standard source materials. There's a little bit under the Morningstar that you can find on Luxoft. There's an abbreviated S&P report that doesn't tell you a whole lot, but gives you a little bit of information. But for the most part, if you want to study this company, you're going to have to really dig hard, and it's never really experienced bad times.
I think that's probably one of the most important things to point out.
Yeah.
One of the reasons that we do, especially for our core holdings, like to lean on companies that have a little bit longer track record, is because they've been tested through an economic test, a downturn, a bear market, correction, recession, whatever. So that being the case, this one has not. Now they are, operating out of Europe. They're in the middle of probably some very trying conditions right now. In a company like this, I would be very interested in a fairly current outlook on the situation. Here's the Yahoo Finance. I just went to Yahoo Finance, earnings estimates, and just taking a look to see if they seem to be continuing to make progress. Again, relatively small company, non-US, tough to find information, but it could be one worth putting on a back burner and keeping an eye on. If they deliver strong results in the economic environment that we're facing today, that would also be a very powerful sign for the company long term and could merit some attention. So we will actually incorporate these estimates into the manifest estimates. Just taking a quick look to see if there's any signs of deterioration here over the last quarter, and that's not the case. They're getting stronger into the face of what's going on in Europe. That's compelling to me. So I would dig a little bit deeper. I'm with Ken. I actually own shares of Cognizant. I probably am not selling Cognizant to buy this one yet, based on what I've seen so far. Fair enough?
Yeah. I'll tell you one on that list that I'm really, really fascinated with. And there's a lot of good information you can find, and I think it's just right in the middle of what's happening today with medicine and with medical research, and that's the company Illumina. If you look, it's down here on the screen with a potential return in the sweet spot. What's that, about 17%?
17, yes.
Yeah. Illumina makes the machines to sequence the human genome. When we first started sequencing the genome, after we actually had identified the human genome, when we first started to sequence them, that process was costing upwards of $5,000 a time to sequence my genes, and then another $5,000 for Mark's, another $5,000 for everybody else's. And And that meant that the tool wasn't especially useful for biomedical research when they were trying to match specific types of drugs to specific types of cancer tumors, for example. When they were trying to do this boutique medicine that basically designed a medicine that fit whatever was wrong with you specifically and your genetic profile. Well, Illumina's machines have brought the price of the genetic sequencing down to under $500 a time. That's a tenfold decrease in price. And they're predicting that that price will fall under $100 a sequence in the next year, year and a half. These machines are selling to research laboratories, to hospitals, to drug manufacturers, to universities, to all kinds of places. And the machines need supplies to keep them going. So Illumina is kind of playing with the Gillette razor model of get those machines out there, as many of them as you can, and then just keep selling them a constant stream of supplies to keep those machines working at capacity. I love the concept. I love the sales line. Mark and I were talking about the data that comes from better investing, and sometimes you have to really interpret the data because this is Morningstar data, which is GAAP, generally accepted accounting practices.
I'm actually pulling from Morningstar or Value Line at this point.
Okay, so this is Value Line data. Okay, well, for a lot of small companies, an earnings line like that is fairly typical to go with a nice straight sales line. You know, it takes some time to get some traction, and this is a relatively small company moving into the mid-size right now. Anyway, I just find the company fascinating, and I think it's worth further study. It's extremely volatile as far as price is concerned.
Right,
extremely volatile.
I thought I might take a moment and come back to the thought about Saturday mornings and doing personal research and actually putting some of this stuff to work. One of the things that we know and we believe with our hearts is that stock prices follow that earnings line. They don't always do it immediately, but they do over time. And if you look and squint at that, you can actually see that as those earnings dipped over time, 3 different times, you can see the prices dip. So this company appears to be a fairly high quality company with a fairly consistent track record over time. If I'm looking to add this thing to my portfolio, I'm probably going to want to search for one of those dips in the future. Maybe it'll never happen again, but if I get another opportunity like this one here, I'm probably going to want to go after it. So in my personal study on this company, I might look for an alert setting to figure out at what point might I really get interested in a company like Illumina. Let's go ahead and take a look at the manifest page. Here's to demonstrate what I'm talking about doing. I'll jump off the stock search page just for a second. What I'm talking about actually putting to work is a patient discipline of taking advantage of that volatility in the earnings. And we'll just drop right down here to the bottom. Wow, this is when Ken was interested in the company just a few months ago. I see why now. But I would basically be looking for a price point that would line up with some of these higher return forecasts. So again, in my alert settings for this company, I might say, let's see, the current return forecast is actually pretty much acceptable. It's probably near one of those points. But I might even do something as crazy as say, I'd like to be alerted the next time that par is 20. What if it got to 20? I'd be very interested in this company.
I'd like to take a look at this graphic. Mark, if you can scroll back to that graphic.
You want back to the Chronicle, Ken?
The Chronicle, yeah. I'd like to take a look at it early on in my research because I want to have a high-quality company, and I want the company to demonstrate either consistently high quality for the last 3 or 4 years, or I want to see improving quality for the last 3 or 4 years. This quality line, this blue one, gets me excited because this company has been upping its quality in huge jumps, and then it reaches about 1.5 years, 2 years ago, and then we're nice and consistent at the high 80s, low 90s mark. And I really like to see that in a company, especially a company that's going from small to medium, which might be indicating that they're finally getting all their finances under control and that the earnings are going to follow the sales in a much more predictable manner than they have in the past. So I really like to see that. Joe has commented online that it's carrying a really high PE value. And I think that I'm going to try to be very diplomatic and tread very carefully.
This is not easy for him.
It's not easy, I know. But I think that better investing sometimes has done us a disservice by telling us that we should not invest in anything with PEs above 30. I think that's great advice for a beginner. I think it's great advice for established mid-size and large companies. I think that 30, 32, 33 mark, suggests there might be some froth in a very large company. But when you have a company where the prediction of growth is 21, 22, 23, 24%, I don't think that a 37, 38, 39 PE is that unreasonable. Now, will that PE have to come down in the future? Absolutely. Why? Because the growth in the company is going to have to come down in the future as well. There's no company on earth that can grow at 25% over 30 years. And therefore, as I do an analysis, I might not want to predict a 39 PE going forward. I might want to predict a high PE of maybe 32 or 33. But just because it carries a high PE at this instant, when I compare it to what its predicted growth is and what its predicted growth has been, I don't think that's enough to disqualify it from consideration as you study the stock, as you take a look at the stock.
I think the problem, as it relates to, as Kim was saying, it really is advice for beginners. It's not easy to get involved in the analysis of an early stage company. Early stage, this one's not quite as early, but this is still a fairly young, immature company. And in that same vein, again, talking about Saturday morning, what do I do as an investor? Anytime you're dealing with a company with a PE like this one, fairly early stage company, if I held shares of Illumina, I would probably, again, be watching for deterioration in quality, because that's telling me, someplace something's happening, dig in a little bit deeper. So I might, again, I hate to keep harping back to the alerts. I didn't expect we would end up there, but I would probably say on this one, yeah, I would want to be flagged or nudged if the quality dropped down from where it's currently at. And I would set that, and then if it did happen, dig in and see what's happening. Because again, keep in mind that a company like this, I can think of an investment I had years ago when I was here with the Chicago chapter with Tel Labs. Just going great guns in the telecommunications industry, a PE just like that one. The chief executive officer made the mistake of appearing on CNBC and telling the truth one day. He basically said, well, we're not going to grow at 30% forever. That's what he said. The next day, the stock price dropped 30%. He told the truth. And that's what happened to the stock price. So again, anytime you have a company like this, and this one's a little more mature than that, but you get the idea of what we're talking about. So again, a little bit of caution, maybe a little bit more vigilance with a company like this one, but all of that's true.
Michelle is asking, on our dashboard worksheet, we have inactive companies. What does that mean? Michelle, I'm not quite sure what you're referring to. If you have sound and if you raise your hand, I'll unmute you and we can speak a little bit.
We can cover that with the next topic a little bit, I think.
Okay.
I'm going to actually build a dashboard.
Okay. Are you talking about inactive companies on a dashboard? Because we haven't yet shown a real dashboard yet. All we've shown so far are some screening results. Okay, well, Michelle's having, oh, there we go, another question.
Yeah,
yes, on a dashboard.
Okay, we're going to cover that next.
Yeah, we'll go there and we'll show why you might put an inactive. I think, I assume by inactive, you mean a stock that
Uncovered.
has 0 shares or that's not covered, one of the two. Okay.
Anything else on this list grab your attention, Ken, as far as the ivory soap screen?
Oh, well, I just like an awful lot of these companies, and I don't like a few of them. I just I just have been burned so often by the Chinese that I just like to stay away from Chinese stocks. So Baidu, while it appears on screen after screen after screen, is not very interesting to me. Just to balance that out, in the big investment club that I'm in, the Mid-Michigan Model Club, our largest holding is NetEase, and that's a Chinese gaming stock.
Yeah,
And it's been extremely good to us.
Way to be consistent, sir.
Yeah, so there's the exception that proves the rule, I guess, you know. But I do like a number of these. I would draw your attention to FleetCor. If you've missed the big boom in Visa and MasterCard, remembering that all they basically do is handle transactions for the banks. Visa and MasterCard do not handle the money that's owed to the banks. All they do is handle the transaction. FleetCor might be one that you want to take a look at. Same basic business model, plus a little bit more than Visa and MasterCard do. Let's say you're driving a Walmart truck for Walmart all over the country, and you need gasoline. Well, the corporation probably has issued you a credit card to buy diesel fuel, and a lot of times that credit card is a FleetCor card rather than a Visa or a MasterCard. So most of their customers are commercial customers using the card. They do have some other jobs that they do besides handling transactions, but it's an extremely interesting company to take a look at. And I would suggest that, again, if you missed Visa and MasterCard and you'd like to have something like that in your portfolio, FleetCor might be a great substitute for that.
For
those are really nice lines, by the way.
Yeah, for those that didn't hear it in our small audience here, we got an ooh on that. Yeah, that's definitely a compelling picture. And again, as we've done for years, we would always encourage anyone in the audience to go ahead and take a look at the Finance Yahoo. What's the picture look like for the end of this year, end of next year? And that's looking pretty good. 621, 689, earnings still continuing, maybe a little bit of a tapering off here. These guys could be recession impacted if there is a recession and moving things from point A to point B, but not a bad picture. And so 621, 689, how's that look on here? That looks pretty powerful. So they seem to be pretty much on track again in a fairly challenging economic environment. So some pretty neat stuff there. That's a good company to study. Throw it up against the wall. Any other questions from any of you guys or anybody in the audience about any of the companies?
Hold it. My question just spoke to you.
So again, this literally, if I'm looking to deploy IRA assets or whatever, this is where I start. And then I'll dig in deeper and start auditing and checking Morningstar reports on these companies and value line reports and just digging in. And it really, I mean, I could make a decision on one of these to invest real dollars in probably an hour or less. And then Ken would call me up and tell me I was wrong.
Sometimes.
Okay, let's take a look at the second thing I thought we would talk about. Again, in the spirit of demonstrating what do you actually do, you can actually sign up at Morningstar.com, good Chicago company, Morningstar.com, and they'll send you their own version of alerts. What they're doing here is sending me an email of companies that have just fallen into the 5-star stock category. They rate stocks from 5 to 1, and that is basically a return forecast driven notification. They're basically saying it has a high return forecast or a good comparison of if the shopping price is on sale versus the fair value for these 4 companies. And what I will sometimes do, and I've done this, by the way, watching Jim Cramer on CNBC, as he's flashing the stuff across there and doing the lightning round, I'll just build a dashboard and play along. Some of those get really interesting. But in this case, all I did here was create a dashboard with the Morningstar 5-star stocks companies. Somebody jot down those tickers so we can remember them. And let's just go ahead and create a dashboard real quick just to demonstrate for you how easy it is to do. And again, I'll do this with ideas from someplace. It could be a watch list that you're building for an investment club. Well, let's go ahead and do a new dashboard. This might take a minute to get started. Just give it a name, Morningstar Chicago. Could give it a little description, perhaps a date, just to give it a date stamp that you might save this dashboard and come back and look later. And what I will generally do in a situation like this where I'm building a watch list is not enter the shares or just the symbols. I'll actually say, what if I invested $100 into these companies today, and it'll give me something to come back to in the future and see, how, maybe I'm attending the Better Investing National Convention coming up in May, and I'm attending the sessions and I'm building a list of companies. I'm just going to invest $100 into them and come back and look at it maybe 1 year, maybe 5 years from now. So we had Acorn, that was AKRX, Novartis. What else am I missing here? Polaris. Oh, Ken, you can talk about Polaris. And Priceline. So I've entered those 4 companies, and then what I'll also do is embed a benchmark ticker to follow alongside. My favorite to use is just VTSMX. That'll basically say, what if I invested $100 today into the Wilshire 5000? And then that'll allow you going forward to compare how these companies have done.
Yeah, hold on just 1 second. A hint that I always used when I was teaching and I use with adults is a lot of times with acronyms,
You just call me an adult.
if you can put words with the acronym sticks a lot easier. All mutual funds end in X, so that X at the end is not part of the acronym, but the beginning there is Vanguard, because it's a Vanguard fund, total stock market. So that benchmark is really easy to remember if you can put those words with it. It's a Vanguard fund and it's the total stock market, and they always end in an X. So people have a terrible time. I get this question, probably 50% of the questions I get is, what's that Vanguard total stock market, or what's that Vanguard S&P one?
True.
It's easy to remember if you put some words with it. So that's my little addition there.
And for those of you who missed it, you just kind of called me an adult. So again, keep in mind what we're talking about here. I'm sitting here on a Saturday morning thinking about where I might invest. Morningstar said, hey, here's 5 or 4 hot stock tips. And if you subject them to a real quick dashboard study, $100 invested into each one. Kurt does the math for us, so he picked out the number of shares. But again, we can compare what $100 of each one of those is. And again, we see the quality rankings. I might sort it by clicking on the column header and look at the one with the higher one at the top. That's Acorn. I happen to know that's a combination generic and medical supply company. Fairly compelling. Interestingly enough, they left the Value Line Standard Edition. They're now in the mid cap, so I don't know what that means. But number 2 on that list, Ken, why don't you go ahead and talk about that one a little bit? That's something that you follow pretty closely. Polaris.
Some of you are asking yourself right now, what's that little asterisk at the end of Acorn stand for? And Mark just told you without telling you, they're in the mid cap Value Line Edition rather than in the standard Value Line. Polaris is a stock that I like. I've owned for a long time. I've been adding to my position as it falls. It had some problems, and it seems to have worked itself out of the problems that I had, but the market hasn't caught up yet with the fact that it's worked itself out of the problems. Polaris makes a lot of toys for adults. It makes snowmobiles, and it makes off-road vehicles, and it makes motorcycles, and it makes 3-wheelers, and it makes a brand new vehicle called a Spider. You'd have to go to the website to see this cool looking Spider kind of thing that it's an adult toy, and they're fairly expensive. It owns the best selling motorcycle brand in the world right now, and that's the Indian motorcycle. They bought the brand from the old Indian motorcycle company. And
he means fastest growing, by the way.
Fastest growing. I said best selling. It's fastest growing.
Our Milwaukee attendees may sign out if you do.
Fastest growing. And they were having some problems with the paint shop on the Indian motorcycles, and the paint jobs weren't being done real well, and so they closed that down. They solved the problem. They reopened that shop and then reopened another paint shop. Polaris also can't turn the Indian motorcycles out fast enough to meet the demand. And by opening some new shops, they've begun to address that particular problem. But you can see that the price right now, with the market in free fall and with the January we've just gone through, the price is down near the 52-week low. I happen to think that things are going to go back to trend, to stay pretty much on trend. The company is predicted they're going to go back to trend with low double-digit growth. And I think that it's a compelling study right now. Take a look at Polaris, compare it to some of the other people that make snowmobiles, that make motorcycles, that make off-road vehicles. And I think it's a great industry study. This is a compelling company. And I think you might want to take a look at it, especially at these prices. Morningstar evidently agrees with what I'm saying by moving it to 5 stars at this point. What did we discover? That it's one of the highest rated companies for the next year's growth in the universe right now, right?
Yeah, for stock price appreciation.
Yeah, for stock price appreciation.
And again, I think this is also an opportunity, Ken, to reinforce what we believe. I mean, this is a company that's got, it's hit a speed bump in earnings. And you can see that here. They're actually projected to come in with less earnings for 2016 than 2015. And again, this is go ahead and look at the visual analysis. This is a company that if we hit an economic recession, I mean, it's going to take a dive. So, it's basically fearing that type of thing from the environment right now. So if we take, what is it, 642 and 714, just to give it a more visual, going into the data, again, we do this for every company. Go into the annual data, go forward a little bit. Again, we just want to give it a visual. What were those two numbers? 642, so backing up a bit, and then
14.
714, doesn't matter, it's close enough. And again, just to give you that here's the picture now, and none of us here, including all of you online, should be surprised that the stock price is going down. And what Ken just said, instinctively, that this company does seem to be repairing some of the challenges, responding to some of the challenges that it faces. Is it going to head back to that line or not? Obviously, if they have some type of massive economic challenge, and they could fail and go out of business, but there's nothing to suggest that.
We should also look at that graph before you take off on it, Mark, that while you can definitely see the recession way back in 2008 to 2009, that's not nearly as dramatic as an awful lot of the companies that we looked at when the recession hit.
That's a great point.
That was a huge recession, and that's a fairly tame backup to match that huge recession that went on. So this company knows how to manage things during a severe downturn, and I don't think anybody at this point is suggesting that whatever downturn might be in the future is going to be as severe as the one we just had. At least they're not talking about it now in those terms.
Well, let's hope not.
Yeah.
We could dig in a little bit deeper some of those other companies, but I think we can move on. Except I do want to respond to Michelle's question. If you enter a stock that's covered by Finance Yahoo but not covered by Manifest, I don't know, Michelle, do you have an example of one that we can inject into the dashboard and demonstrate that? We might do that. The only other point, while Ken is checking the answer field here for that, Novartis we talked about a little bit earlier. This is a really good long-term company. We're looking at the analyst consensus of expectations. We're just not quite as excited about the company as Morningstar appears to be. In other words, let me translate that. Morningstar is one opinion. It can often be a very strong or good opinion, but in this case, between Value Line, Standard & Poor's, and the other companies that we follow at Manifest Investing, they're just a little bit less optimistic. Nothing wrong with an 8% or 7.9% return forecast for a company that good. Don't get me wrong here. It's just not as compelling an opportunity. And again, those ones up at the top, you're doing a little bit of fence swinging. Any money going into Polaris right now, a little bit of fence swinging. That's a little bit more speculative, but not a lot. Not a lot more speculative.
We just had a question about how comfortable am I with the analysts' projections for Polaris. Well, remember that Manifest is based in a great deal on analyst projections, and the analysts are basically showing Polaris with a par value of 25 plus. I will tell you that the SSG that I do on Polaris is closer to 15, 16, 17%. So that means I'm not nearly as optimistic as the analysts going forward, but you know, I'll settle for 15%, and if it gives me, what was the number, 27%?
Mm-hmm.
If it gives me that, I'll take it. So I think that you don't have to agree with the analysts when they're that high to still get an awfully good projected annualized return on your own study. And that's what you want to base your final buying opportunity on. That's especially when I would go into the Eagle and I would substitute my own judgments for those of the analyst community and see how close I come, see where I'm going to be.
Because some of them are a little bit scattered. And again, just putting the gravity of this whole thing in context, take a look at those EPS trends just over the last 3 months. Take a look at where the estimates have gone for the end of this calendar year. From $8.33, this is just in the last quarter, down to $6.42. You know, what do we as a group of investors expect to happen? The price has got to go down, and it's going to go down fairly significantly. The only question to be answered is, do they return to trend? And if they do, it's a compelling opportunity. Same thing for the next year. I mean, those that went from 950 expected for the end of 2017, that was trimmed all the way recently back to 714. The other thing that we witness historically, and this is kind of where Ken is coming from, is the analysts do tend to get scattered and frenzied. They all talk to each other. They go to lunch together. They get scared. It's a panic. I literally have sat with tables of analysts at lunch and watched them all get each other into a frenzy and everybody frightened. Go back to your desk after lunch and sell a particular company. I'm not making this up, okay? So they will overshoot, you know, and perhaps you'll come back in a few months and Polaris will address the process challenges that they have, and suddenly that 642 will start creeping back up. So very often they'll overshoot. Think about pendulum, they'll overshoot in both directions. And we, as a group of investors, can really take advantage of that by watching for things like we're demonstrating here. Ready for the next one, Ken? Did Michelle give us a ticker to look at?
She didn't, but another reason, Michelle, another reason why you might find an uncovered company when you do a manifest dashboard is that just as you can't study a company on an SSG that doesn't have earnings, you can't make a very good forward-looking call on a company that doesn't have any earnings. So many times if people ask to cover a company with no earnings of any kind, it's pretty difficult to make a manifest call because you have nothing to base your numbers on. The same thing's true about a company that's very, very new, an initial public offering. With virtually no data, you can't make a forward-looking call with any kind of fairness attached to it. So often you'll find companies with no earnings and companies that are very, very new, you'll find them uncovered as well.
Yeah, and what I've done here is I pulled up, this is an institutional dashboard for an investment advisory firm. This is just to give an example. I think this is what Michelle is talking about. You can confirm if I'm on it. There's a ticker. There's obviously some data here. Yahoo gives a price, so you can actually track it in the portfolio, but there's not enough information to give any of the other, you know, if you're talking about a stock, these fields would be blank unless we found that we could cover it. And if you want us to cover a stock, the quickest check you can make is to jump into, if you have an uncovered ticker here, jump over to that Finance Yahoo screen and see if anybody's covering it. A lot of times you'll see no analyst data at all, and that just gives you a heads up. We might be able to pull it from somewhere, but just keep in mind that sometimes it's very difficult to find information, particularly on some of the smaller companies.
Mark, try CUBI. Marie says it's been added to the investor advisory service, but doesn't seem to be covered in manifest.
Well, now I got to go back to, well, they give me an opportunity to demonstrate a couple of things here. Hold on. Because that email that I just showed you from Morningstar actually came on Monday morning. So I created this dashboard. So this was the dashboard on Monday morning, And you can see that the 4 selections, $100 invested into each one. Wow, 2-day performance, they're 4 for 4. All 4 beat that stock market benchmark. We're now 3 days into it, and you can basically see that's where it started. Now, if we need to edit that, we'll go in and edit. What was it? QB?
CUBI, yeah.
I'm not familiar with that company at all, Ken.
I'm not either.
Oh, it's a bank.
It's a bank.
Are you guys familiar with it?
Well,
Customer
it was
Bank Corp?
just in the investor
Okay.
advisory service, which came out, I think,
That's
last week.
definitely worth a closer look. Short commercial for the investor advisory service, the leader in this year's Groundhog Challenge. That's our stock picking thing at Manifest, which will be ending here in 1 business day. All she did was, Anna Gombar is the one who's winning right now. She sat down and in a matter of about 5 minutes, did a quick Manifest screen. She was the one that Ken started this session off with, and she threw in companies that she recognized from the investor advisory service that were high on that list. That's all she did. And she's winning the contest for this year. So everybody's invited to try to keep up with Anna for the next year. But again, if it's a company that we don't follow, as you can see in this case, it won't have this information out here. And again, if you want to look at the probability that I'll be able to say yes to you, just come to this screen and enter your company. And I suspect this one was a yes. And I'm certain it's a yes now, because there's data here. And we can actually embed the next couple of years of data, and a fairly compelling opportunity. Let me just sneak a quick peek down here. Yeah, we're talking about a 12% growth company. Not bad.
Yeah, I will testify. Mark doesn't pay me. I don't make any money from Manifest or anything like that. But
I buy shakes every once in a while.
You see that? Yeah, I get a milkshake every now and then. You see in the bottom right-hand corner, you see that leave us a message. If you come across a company that's not being covered, they really do mean, Mark and Kurt really do mean leave them a message. Just type in there, why can't you cover CUBI? Or would you cover CUBI? And he'll either do it or he'll tell you why he can't. And it's a great thing.
Now he'll tell me to cover CUBI when I get back home. All right, let's go ahead and press on. Go to the next dashboard.
Mark, we had a question. How did you get Morningstar to send you this alert? That was one of the questions we had.
I can't remember specifically, but if you go to Morningstar.com, it's been a long time since I did it. If you go to Morningstar.com, I'll look real quickly to see if I can remember off the top of my head, but you might have to do some digging and do some stuff here, unless it comes to me right off the top of my head. Somewhere in here, you're allowed to go into your account settings and ask them for certain notices. And I'm not going to remember it off the top of my head, but you can actually ask them to send you notifications on a variety of things.
Mark, is that a free service, or with Morningstar you have to pay for that?
I think this is probably a subscription, but you can probably also explore doing it through your local library. And I know that's true for many of the libraries around us. It's probably true here in this area, that often your library card will allow you to be just like a subscriber to Morningstar. And I'm pretty sure they'll let you do that. Let me know if you can't, because I would like to know the answer to that. But this is where I did it. And again, it probably comes somewhere under, I apologize for not knowing off the top of my head, but there's probably somewhere on here where I can actually go into account settings. Like I said before, it's been so long since I did it. It's just become second nature to me. They come every morning, and I just get that little nudge. And again, Morningstar treated it as a single opinion, but can be a lot of fun to track that type of thing. Any other questions or comments at this point, guys? Looks like we're clear on the board. Let me just take a moment just to remind everybody. I know several of you in the audience have already taken care of this for this year, but this will be new to some of you. We do run a contest every year. It's fun. It's just simply fun. It's referred to as our Groundhog Challenge. This will be our 10th annual contest where individual investors and clubs submit stock picks for the next year. You have to pick a minimum of 5 stocks, a maximum of 20, and we enter them into a dashboard. And then you basically, they're frozen, they're locked in. You can't make any changes to the portfolio from Groundhog Day to Groundhog Day. And we've had, like I said, we have 9 winners. I did make the mistake of winning one of the early contests, so it brought the whole thing into question. He's left the room for a minute, so I can talk about him. I beat out Ken on the final day by literally just dollars. It was so cute. A couple of years ago, we had a group of ladies, 4 different ladies up in Minnesota that were all within like $10 of each other for the final week. That hasn't happened since then, but it can be a lot of fun. And again, we encourage individuals and groups to join. You can go, if you're a Manifest subscriber, just go to this page and you can either post your entries here, or you can send me an email. Again, 5 to 20 stocks, no penny stocks, please. But just to give you guys a feel of, we take $1 million and spread it evenly among the companies that you submit. Let me squeeze this back down. Here's the current standings. And Herb is in the audience. Herb is hoping that Anna has something drastically go wrong with one of her stocks on Monday. But Anna, she was the one I was referring to earlier. Literally, Rod was putting in his selections last year. She saw what he was doing, and she sat down, ran a quick screen, and anything that resonated between the Manifest screen and the Investor Advisory Service for Better Investing, she picked. And she picked those 5 companies. So we invested $200,000 into each one, and so $1 million. So she's up 22.2% year over year. Again, it's been a tough year. Ken and I were remarking, we're not going to go through the pain again right now, but we're remarking that our entries are pretty far scrolled down that list. We don't need to go there. But again, just for fun, the participants in this contest do take it seriously. They don't try to do silly games with penny stocks because, frankly, it doesn't work. I mean, it really doesn't work over time. It might work one time out of 100, but many things. I do want to take a moment out and acknowledge, in case we have anybody here from St. Louis, there's an investment club of ladies, and they actually tolerate a couple guys in the club called Broad Assets. And they've actually won the group contest, as you know, sending in their entries as an investment club a couple of times already. They're a multiple-time champion. Looks like they're going to win the group entry again, unless Noah's Ark from right here in Chicago. That's Andy Pagorik's group. Would have been nice to see Andy this morning. Or Sirius Investment Club, I believe, is one of the model clubs with Nick Strategos out of Pittsburgh. So they're in the running, but the ladies from St. Louis look like they're going to win again. And that starts to become statistically disturbing because as you go down this list, again, I don't want to spend too much time, but there's a number of, the ones with parentheses are clubs. You can see there's 20 to 30 clubs in this year's contest. There's been as many as 50 or 60 in the past. When you beat that many clubs that many times, and they are the all-time performance return leaders of because we keep track of all 9 years. Susan Wacholik out of Janesville is another one. She's right up there at the top, year in, year out. We keep track of them all. That becomes, like I said before, statistically annoying. Ken wants to go see them. And they've already submitted their picks for this year, so send me $20 in a brown paper bag, and I'll give you their picks for the next year before Monday. No, I'm kidding. But again, it's just meant to demonstrate that a whole bunch of lunatic investors can have some fun, and they can do it while still sticking to, for the most part, up straight and parallel stocks.
Yeah, I'll tell a story. We've run a stock contest for 13 years in mid-Michigan also, and you'd think that a short-term stock contest people would play games with. And we ran the whole program last November. We culminate the contest with a breakfast. Mark comes and talks, I talk. And the theme of the program was...
I got a certificate this year.
Yeah, Mark actually was up in the top something
Leaderboard, yes.
But the whole theme of the program was stocks that everyone knows. Because the winner and the second place company, or second place club, and the third place club, their portfolios were just jammed with stocks that everybody knows. Just plain old ordinary, better investing discovered kinds of stocks. The only exception in all 3 of those top portfolios was an IPO that came out of Flint, Michigan called Diplomat Pharmacy. It's a specialty pharmacy. It's doing quite well. But because it was local and had a big splash in all the papers, a number of the clubs included that in their 12 or 14 or 15 stock portfolio that they put in. But that was the only swing for the fences kind of stock in all three of the portfolios. The rest of them were just common everyday stocks everybody knows. You can have great returns with a nice boring portfolio. You don't have to go looking for names of companies that nobody else has ever discovered in order to make good money.
But your diplomat example is a really good segue to the next thing we're going to cover. Did you do that on purpose?
No.
No. So it's an accident. And again, what we're going to talk about now is some of the smaller, faster growing companies in your portfolio. I mean, I'm reminded of discovering II-VI in Pittsburgh, Neogen in Michigan, and there's companies like that all around. Back in the day, I mentioned Tell Labs earlier, here in the Chicago area.
Mark,
you can find a good, strong company.
Herb's hand is up right now, and he has interesting things to say a lot of times.
He wants to brag.
Let's unmute Herb. Herb, if you're going to brag, you can't brag for more than a minute. Okay, here you go.
If it's above 70 degrees, we're going to cut you off.
Actually, I did not call to brag. I was actually going to make a question about, in a recovery for a market that's gone down as much, doesn't it stand to reason that you invest in quality large cap companies rather than small caps? And doesn't the recovery go better in the large caps than the small caps?
Oh, that's a great question. Well, it depends on where you believe we are. And if you think we're still falling, you basically seek the oasis of safety. I think that we've fallen a ways. We're probably heading back fairly soon. And actually just the opposite of what you said. If we're on the way to recovery, the companies that have been hurt the most, the so-called January effect, the companies that have fallen the most in the last quarter of last year, many of them were smaller companies. So it can make sense. And the other point to be made is people have been rushing to defense for months. So many of those are now overvalued, not attractive. So you want to be actually more careful with the larger companies, even in a defensive mode. So if you have faith in the recovery, it probably is time to go shopping again in the area we're about to talk about, the very high quality, best small companies.
Well, that's going to be interesting because one of my contests for next year, I use nothing but small caps. So we'll see how that works out.
I think you're probably in pretty good shape swinging for the fences. Your long-term results can take just about anything. Herb, you're so far up there.
Are you still on the beach in Florida, Herb?
Yeah, I'm still down in Destin. It's nice and sunny. It's about 70 degrees. It's
Okay.
beautiful.
It's actually 45 here in Chicago, so we can say it's beautiful here too for a change.
Yeah, we're going to lay out and sunbathe in the parking lot when we're done here.
Thanks a lot. I'm going to put you back on mute, okay?
Okay.
All right, so I'll let Ken share this one. Again, this is something we have done as a tradition for many, many years, both at the Better Investing and at Manifest Investing. And that is basically a community hunt or quest for intriguing small company opportunities. This is probably one of our favorite shopping experiences all year long. And Ken has been spearheading it for years for us. So,
well, I was always looking forward to October 31st or thereabouts, and it had nothing to do with Halloween. It had to do with the fact that Forbes would put out its list. Some years it was the 100 best small companies. Occasionally it was the 200 best small companies, but Forbes would put out that list religiously, and then I would mine that list for 20 or 30 great ideas, and that would give me a lot of stocks to study for a long period of time, usually a dozen or so names that I had never heard of before that were just kind of evolving into great growth companies. And Neogen, for example, is one of the stocks that I discovered way a long time ago. And then the guy came to our investors fair and cemented the whole thing for us. But it got close to Halloween this year, and Mark was communicating with some of the Forbes columnists and came to find out that Forbes had decided that they weren't going to do their list this year. In fact, they were going to go to a new list, and they were going to talk about the 100 best non-public companies.
Unicorns.
Yeah, companies that were out there, you know.
Look at the looks on their faces. Why would they do that?
And it's an absolutely useless list for investors. Now, there's an exception to that. If you're sitting around home with an extra 7 or 8 million and you'd like to drop $1 million into a company and, be an angel investor, well, they'll take it and let you buy shares that way. But for those of us that invest through the regular stock market, that list was useless. Well, we talked back and forth, and finally, with the arrogance of not knowing everything, we both decided we should be able to put together a list of what we consider to be at least the best 50 stocks that are small cap. So we said, let's create some criteria. Let's cross-check these against a couple of other sources, and let's come up with a list. The criteria was pretty simple. We wanted growth in the double digits, so growth above 10%. We were going to exclude financial stocks from the pile because they don't compare really well. And besides, the Forbes list had always excluded financial stocks as well. We wanted to look at companies that were small enough to be small, but big enough to have some kind of presence in the market. So I think we set either 50 or 60 million as the basis, 50 million as the basis. And then to exclude some penny stocks, we said, well, let's at least have them trading at $5 and above. We said all the way up to $1 billion in revenue, we would consider small. And I will tell you that in the new Investor's Handbook that's being considered for better investing, and that should come out in the next 6 months to a year, you'll find that they are also going to rethink their numbers for sales amount. And right now they're tossing around the numbers 1 billion and 10 billion for your dividing points. So less than $1 billion small, 1 billion to 10 billion medium, and more than 10 billion large. Those sound reasonable to us. And then we were also going to demand high quality from these companies. We weren't going to tolerate a small company that came in with a quality of 11 or something like that. So we were looking for high quality in our 50 choices.
And that's actually a very important thing to reinforce. I mean, when we first started doing this back in the early part of the last decade, Ken was always preaching about, and he preaches a lot, as you guys could probably tell, preaching to me about, you still got to demand quality from these smaller companies. You got to still demand quality. And it makes them a little harder to find. But if you go back and actually look at the dashboards, and you can do this at Manifest, you can go back and look at the dashboards from 2005 and 2008 and notice that the more successful companies on those tracking dashboards are the ones that were higher quality, that were there to start with and maintained it. So that's one of the reasons we stuck with it. And the one other clarification I'll make is that we did stick with the Forbes convention of excluding the asset-based businesses, the businesses that depend on building a pile of money, that we'd be more likely to use a return on equity analysis. So that is what we included.
Banks, insurance companies, mostly. Yeah.
So what's on your slide today is basically looking at the ones that survived our list, starting with the high, as Ken has been preaching, we started with a quality sort from highest quality.
I can remember as just a chapter volunteer sitting across the table from some of my esteemed colleagues at Better Investing headquarters and some of the folks that were dealing with the Investors Advisory Service, and telling them that we should expect out of our small companies the exact same kind of characteristics that we expect out of our large high quality companies. And they looked at me and had that I'm a professional, I know better look in their eye, and told me, well, if you become that strict with your small companies, you'll never find any. And
I just wanted some of what he was having.
And I knew that wasn't true. I knew you could find those companies. You just had to be patient. Well, here's our list for now, and you can see that it's headed by one of the companies we've been, it's not headed anymore by that company.
Well, it's sort of from highest quality to lowest.
Okay, so it's changed a little bit. You can see it's a company that Well, frankly, neither Mark or I had ever really studied this company.
Are we talking about Popeyes?
Yeah, we'd never
Let's
really
look at
taken a
Popeyes.
look at it or anything. And
I still haven't looked at it much.
you know, Popeyes is moving into our area up in mid-Michigan, and it seems to be growing nationally. I still never have gone to a Popeyes, but that's kind of a compelling picture when you take a look at that. I don't look at restaurants as much as I look at a lot of other types of stocks. I've been burned a number of times by restaurants, but that being said, I own a restaurant. I own Buffalo Wild Wings. I actually own two of them. I also own Starbucks. And I think this is a pretty compelling small company picture. And one of the things I tell people when they're looking for a great small company is that up, straight, and parallel still should be part of your discussion. And I like to say that if you're going to have a slightly wavy blue line, then you better have good consistency in your green line for at least the last 5 or 6 years. And I think if I count those dots, 1, 2, 3, 4, 5, plus the 3 quarters that are into this year, I think I'm pretty consistent, you know, after that recession in this company.
Well, yeah.
So it definitely meets my study criteria. And that's all we're asking is that
Right.
you get some good study ideas,
Well,
not that you buy.
we're digging in deeper, and notice this company was extremely impacted during the 2008-2009 Great Recession. That stock price is taking a considerable dive here as the earnings flattened out a little bit. If I'm studying this company for the first time, I'm going to go looking for a change in management. Did they have some type of a change in management, a shift in structure, culture? How did they respond to that period, very challenging period? It appears to me that they're doing something right. What's the reason for that? And again, let's jump over to our traditional Yahoo screen just to see what that looks like for these guys. Because again, recently, many of the retailers, much of the retail food industry have come under pressure. So it'd be interesting to see if there's any pressure here. And I don't see a whole lot. So, I mean, this company still seems to be firing on at least 7 out of 8 cylinders. And it looks more compelling to me all the time.
Yeah, the one thing that I saw in the visual analysis that gives me a little pause, if you can go back to that graph real quickly, Mark.
I'm playing the value line, okay.
If you were to connect the midpoints of those price bars for the last 6 or 7 years, I would like to see that price stay relatively parallel, that line that you would draw, stay relatively parallel to the sales line and to the earnings line. And the fact that that price has really been moving up either tells me the stock was grossly undervalued 5 or 6 years ago, or it might be becoming a little bit frothy right now as far as price is concerned. One of those two things is happening, and that would give me pause to take a look at was it really, really undiscovered and undervalued back in 2000? That's probably 8 and 9 back there with those low numbers. Yeah.
Yeah, and I would turn to, specifically how have they recovered from a profitability standpoint. And I got to confess, we discovered this during a recent session. I had no idea this company was this profitable. And what you're looking at here is the net profit margin. There's been quite an expansion from down around, here you can see 12, 13, and we're now up in the 16 range. So again, if I'm studying the company with my club partners, I'm going to want specifically what happened, what did they change, what's going on with the company, and try to answer that question, and that will lead you to an ability to say, do I think that's sustainable? Can it continue?
I'll give you one thing to ponder about Popeyes. When chicken prices began to move up, the biggest move up in chicken prices was in wings, believe it or not. And one of the companies that had some problems with that, of course, was Buffalo Wild Wings. Popeyes, just about that time, started featuring legs, drumsticks. And those prices, among all the chicken parts, those were the only prices moving down rather than up. And you can see that it's translated into some margin. You sell the whole chicken rather than just the wing. You have a better opportunity to expand your margins when it's all going correctly.
All right, so that would be a worthy study. The return forecast is a little bit subdued, so maybe we talk about somebody with a little bit more exciting potential now. As I scroll down this list, for one that I would like to bring out is Mesa Labs.
Okay.
If you're not familiar with Mesa Labs, this is kind of I missed the boat on Neogen, even though Ken told me that I was missing the boat, and I still missed the boat. If you go to Mesa Labs, and I consider this to be a poster child for you can find up, straight, and parallel even in the smaller companies. And this is no surprise to many of you in the audience. There's probably a few Mesa Labs customers in the audience, or shareholders, excuse me. That's a pretty nice, compelling story for a relatively small company. And we're talking about a company with under $100 million in sales. And it's a Colorado-based company, continuing to kind of fire on all cylinders, relatively steady profitability. I don't think we've gone to the back yet on anything. Notice that the profitability is maturing, but still pretty steady. Has had a bit of some pressure back in 2014. So we would subject that to the same test. Are they continuing to see that type of pressure this year? But this is an outstanding study if you're not familiar with the company. Take a closer look. You'll see that the earnings are projected to go pretty much through the roof.
The fourth quarter earnings just came out. You can see what it did to the stock price on Friday.
So it got punished. Again, potential opportunity if you believe in the management and the execution potential for this company.
Well, obviously they beat. Look at just the price movement on Friday. If you scroll up when the earnings came out.
Earnings came out, you say Friday?
Yeah.
Also, I really should have been telling all of you in the audience about this. Well, we have. I mean, this is a company that has been covered at our roundtables. If you're not familiar with the roundtables, we do monthly sessions.
This is the kind of company that a thorough industry study can uncover. And I've been a proponent of industry studies for 10 or more years now. The model clubs, both of them that I belong to, own Mesa Labs. And we came to Mesa Labs about 5 years ago when this company had revenues probably less than $30 million. We came to it 5 years ago in one of the clubs as a result of a pretty thorough industry study. This company has a lot of history to it. It's not a young, initial public offering. And it's the kind of company that we love in small companies because it does so many different things and it does them really well. And we're kind of crossing our fingers that in the next 3 years, somebody's going to realize all the great things that are in this company and are going to buy it at a premium.
As long as they buy for enough money,
yeah.
They won't be upset.
This year we had 3 companies in our model club portfolio bought out from underneath us. And we love having that happen. I mean, you have to pay capital gains as long as they're paying enough, right? But it's a great thing to have happen, and it frees up a lot of cash when you have a big portfolio to go shopping again, too. But we're hoping Mesa Labs is in the same situation. Well, this is the only small cap holding that I hold in my personal portfolio. It's the only small company right now that I hold personally as well.
You need to get to work.
Well,
yeah, there's
I'm pretty happy with my portfolio.
Let me just reinforce that where you can find the entire list of 50 of these companies, especially if you're a Manifest subscriber. If you're not, just send me a note and we'll help you out. If you go into the published dashboards and just click for more, because we would just put the main ones on the main screen, you can toggle down. You can see all those old Forbes lists. Those are kind of fun to look at. But go down to, I think it's here as this one here, Forbes Manifest Investing Best Small 2015. You can see all 50 of them here. We have the tracking dashboard. The one actually doing the best, which most of you would be gun shy with, except for Nick in Pittsburgh, Francesca's. That's actually up 27% since Halloween. You can see that we put in prices right around Halloween. $100 invested on Halloween is all the way up to 27%. Notice Luxoft is on this list that we started with. And one of Hugh's favorites, AeroVironment, NIC, good study. Ken has presented a number of times on NIC, ticker symbols EGOV. That's a worthy study, might not be in the buy zone right now.
Joe is asking a question right now, and Joe, I wish you were in the room to see me. I'm smiling. I'm halfway not serious about the answer I'm going to give you, but I'm halfway very serious about the answer. Joe wants to know, He says, Mesa Labs second quarter earnings are down. Why? And Joe, the answer I'm giving you with a big smile on my face, so don't get angry at me.
We can vouch for smiling.
Yeah, the answer I'm giving you is I do know why, but it's a great reason for you to study the stock if you're really interested in Mesa Labs. I think sometimes when we present at Better Investing audiences, people not only expect us to identify the good ideas, but then they expect us to do all the research as well. Well, since I own it, I've done my research on it, and I would suggest that it's not a really difficult reason to find out, and I would send you to their website, and I would send you to their second quarter earnings call, and you'll get a really good explanation of why the second quarter earnings were moving in the opposite direction of sales. We're at the third quarter right now, and I think that Mr. Nicholson was absolutely correct when he suggested that we really shouldn't be watching these companies in their little ups and downs quarter to quarter. We should be looking for long-term trends, both into the future and in the past. And
especially one as steady as this one.
And you know that the original stock selection guide never even had that little corner for most recent quarter. It was never even on the original stock selection guide.
You get a timeout. That's blasphemy.
Yeah. So I'm not really worried when one of my great companies stumbles a little bit. And again, the reason for the stumble can be found in the second quarter press release, which is very easily accessed right on their website.
All right. Any of you in the audience have a company that you'd like to highlight or take a look at?
Irina is giving me applause, and she's rolling on the floor laughing her blank off. Okay.
That's because they love it when you're in timeout.
And Joe goes touche. Okay.
All right. Let's take one last quick look. I don't even remember off the top of my head what we slated next. Well, just a reminder that we put out this kind of stuff on a weekly basis at Manifest Investing, regular screening results. This is a monthly screen where we'll go through and look for the companies that have the same thing we started off this session with, fairly powerful return forecasts, fairly high quality ratings, so that automatically qualifies these companies for the list. And then we take a look at the long-term expectations from places like Value Line, Morningstar, Standard & Poor's, and then the last three columns on the right are actually short-term, painfully short within our community, but 1 year expectations from a variety of different sources. But it allows you to compare them kind of side by side. I'm not convinced that there's any particular strong value in finding consensus across the board, but if, for example, I'm looking at a company that everybody seems to love but Value Line hates, I might want to dig in and see what does Value Line have heartburn over. But there's some pretty good companies right now. In response to Herb's question, I think you can probably go either way and still continue to invest in, a long-time blue chip leader like Apple, and along with some of the more, I don't want to say speculative, just a little more frenzied smaller companies that are on here. Notice that Biogen, IDEC did make this list. Under Armour makes the list. There's just some fairly interesting studies on here, and we do put that out. Ken's reference earlier was for, was it Biogen? Company that seemed to be dramatically underpriced, or it was actually Polaris. We actually take a look at the analyst consensus estimate for 1 year from now. For all these companies, that's what's shown in the 1 year. ACE stands for Analyst Consensus Estimate. And we're basically looking at the total return, that's price appreciation and dividends 1 year from now for these companies. Now we're actually doing research right now into how reliable that is. And I'll give you a hint, it's probably not terribly reliable. In other words, these are probably not all going to come true because we know that short-term forecasting is a real bear. And but you basically have estimates there from S&P. That 1 year power outlook refers to an outlook offered by either Goldman Sachs, Merrill Lynch, or JP Morgan. And the reason we watch those guys is they move markets. You could have a situation where you're the stock watcher for one of these companies and all of a sudden Goldman Sachs decides that it really doesn't like the company. What happens to your stock price? Well, when you know that's happening, when you know that Goldman is basically launched an assault on your company, you can at least share with your club partners, hey, our company's fine, Goldman just beat it up. And, maybe they'll come back to the party, but at least you have some information to share. Notice that Under Armour has a pretty speculative or a fairly strong one-year outlook according to Standard & Poor's. That's 67% that you can see there. So again, we put these out monthly, we put them out weekly for the update companies. We can take a look at that in a minute, but what I thought we might do is just take